Hello guys, thank you very much for joining in. We're going to be starting out with this chapter, basically what is alternative investment. Okay, now this is a introductory part because there is a subject which talks about introduction to alternative investment. This is the first chapter into that. Okay, and from the name itself, okay, it will give you the introduction to different types of alternative investment products. Okay, and it will also tell you some history about it, then some general concepts which is connected to your risk and returns of alternative investment. Okay, so with that, let us start with the first learning objective. The first learning objective over here is different categories of investments, okay, and which includes a lot of them, which primarily includes private equity, private debt, your real assets. All of this will be discussed in this first learning objective. Okay, now first of all, before we start the journey, okay, what exactly is alternative and how it is different from a traditional investment product. Okay, traditional investment product is very simple, which you must be hearing about. A lot of people or a lot of investors are putting their money into. Okay, so investment is putting money into something which will give you returns later. So you're foregoing your consumption today. Say for example, you have 100 rupees with you. 100 rupees is a small amount. 1,000 rupees with you. You can use that 1,000 rupees to go and watch a movie. Okay, if you're going to watch a movie that is consumed, or else you can invest that money into an asset which will give you benefits in the future. So whenever you make an investment, you're foregoing your spending today and you're expecting a return in the future. Okay, what is a traditional form of investment? Cash. It is nothing but say fixed deposit in your bank. So you put money into the bank and bank will give you returns. Very simple, very basic, right? Bonds and stocks. Stocks are nothing but shares. Okay, say for example, today if I go to stock exchange, NSE, BSE, New York Stock Exchange, there's a company listed called Apple or Tesla. I buy a stock of that company and I become the owner of that company, a proportionate owner of that company. Okay, bonds are slightly different. If any company does not want to give the ownership but they need money, so what they will do, they will issue a bond, and on that bond they will say that I am going to give you interest. Interest is nothing but coupon. Interest is nothing but coupon. So companies, they raise money to invest into projects, invest into new ideas. Similarly, government, okay, US government, Indian government, they also raise money. Okay, so that is the broader view of what exactly is the traditional investment and how does alternative investment looks like. Okay, now alternative investment can be done into variety of asset, but for the benefit in your curriculum, they are bifurcated into these four categories. Okay, real asset, which is nothing but buying a land or a property. For example, I have purchased a commercial property of office. It could be a plot. It could be a residential house also. Similarly, hedge fund, okay, private equity and private debt. We're going to be talking more in detail about this in this chapter. Now, real estate, okay, the broader term for that is real asset. So we're going to be talking that also in detail. Okay, what is a hedge fund? What is private equity? This slide is only giving you the brief overview about it. Okay, look at the example. Suppose you have 1 lakh rupees. Instead of investing that money into a traditional asset like a stock or bond, you would prefer to buy a land, or you would prefer to invest into a company which is a private limited company that is coming as a private equity. So a lot of these startups, okay, like for example Zepto in India, okay, previously Zomato, when they were not listed, okay, Zomato was not listed. So if I am an investor and I want to buy some stake, it is basically purchasing a stake in a private company. This is a private limited company. Okay, that is the thought process. Okay, so these are the few examples of alternative investment. Who ideally uses alternative investment? Okay, now over here they have bifurcated it into a institutional investor or a retail investor like you and me, but you and me might not have that much amount of capital available to invest into these alternative investments. So that is where the wealthy individuals like ultra rich HNIs or HNIs who have money, extra money available, they invest into alternative investments. Okay, so broader categories, these are institutional investors. Pension funds, okay, there's a company called TIA, which is a pension fund, TIA, pension fund for Teachers Association, okay, in US. So teachers are investing their money into a pension fund, and that pension fund has huge capital available which they go and buy stocks, bond. They might also purchase real estate. They might purchase stakes in private companies also. Likewise, okay. University, Harvard University, IIM, IITs, they have their own fund, and through that fund they make investment into one of the ways they invest into is into alternative investments. Charities, there are foundations also, charities and foundation who do philanthropic activity, like for example Bill and Melinda Gates Foundation, Azim Premji Foundation. Okay, so they have some amount of capital that is available and they invest into the market. So they can invest into stocks also, bond also, and also into alternative investment asset. Now these institutional investors, specifically one which we talked about, these institutional investors generally do not need money in an immediate basis. For example, a pension fund. Okay, let us assume Shubham, Tejas, they have purchased a pension fund. Now this pension fund, okay, will give them money when they retire. So that is going to happen after 20, 30 years. So now when the pension fund is investing money, they are looking for something which is called as stable and long-term returns. They do not want money immediately. That is a very important point that you need to understand. Okay, and not every institutional investors are investing into alternative. What is that? See, why I have explicitly mentioned this? Because in India there are mutual funds. Okay, so generally they invest into gold. Generally they invest into stocks, bond, like that. They don't go and buy real estate properties. So it also depends upon whether there is any regulatory restriction, okay, with respect to the institutional investor. Okay, for example, insurance companies in India, they have very limited amount to invest apart from government bonds or the corporate bonds. Okay, so they have very strict investment mandate, which is coming from the government regulation. Okay, so there is big institution, there are wealthy investors like Rakesh Jhunjhunwala, okay, Mohit, there's Rakesh Damani, okay, Ratan Tata. These are ultra rich HNIs. They have excess amount of money available with them. So they not only just invest into stocks and bonds, they also invest into alternative investment. Okay. Now this is where the real section starts. Okay. What are the different types of alternative investment? First is real asset. We're going to be talking about that first. And then you have the three more variations over here in terms of the introduction to alternative investment. Okay. This is the bifurcation. So previously we read about real estate, which is nothing but which is a part of real asset. Okay. Physically, you're holding something. It can be, see this line, it can be land, it can be building, it can be natural resource also. Okay. So for example, I have a coal mine. That is also a real asset because I can use that coal and generate revenue. I can sell that coal and generate revenue. Okay. Hedge funds. Now hedge funds is a slightly complicated topic because what happens is, they use variety of strategies. There is a specific chapter in your curriculum talking about hedge funds. Okay, they use variety of strategies like long short equity. They have macro trend related strategy. They have futures related strategy. They use to make money for their investors, and they take high risky bets. Okay, private equity, like I already said, they invest into private companies. Basically, they want to invest into those companies which are expected to grow. Okay, so for example, if there is a small startup, okay, it's a private limited company right now. What I will do, I'm an investor. I will buy some stakes into that company. I'll give guidance to that company. I'll invest funds into that company so that the company can grow and do an IPO. It can get listed and then I can exit. That is what a lot of investors do when they invest into private limited companies. Okay, private debt is something similar to a bank loan. Okay, a traditional way of getting a loan is to go to a bank or a financial institution. But there are private lenders also who can give you a loan. They are not banks, but they can lend you the money. Okay, so these are the four categories of alternative investment. Now over here, this is from the book. Okay, as per 2023. Okay, what has been the bifurcation? Where exactly is the percentage? Okay, so we definitely see private equity being higher. Okay, now why private equity being higher? Because what happens is, this is where you will see the majority of the growth. Okay, this is where you see the majority of the growth. Why? Because if you invest into private companies, okay, for example, Suppose DMart in India, which was not listed few years back, right? If you had invested, now the price is so high, so you get 100x, 200x return. That is where majority of the money is going into private equity as of now. Okay, Shubham, I have answered your query. Since the base rates were high, so a lot of capital went into that. See, the returns were high, and that's the reason a lot of capital was entering into that area. Okay, Shubham, I have answered your query. I'm taking a pause. I hope everybody is good till this point. Can I get a quick confirmation on chat? All good till this point? Okay. Slowly, the concept is going to be slightly, the first chapter is still easy. Slowly, the concepts will be slightly higher. Okay. First part, we talked about real asset. Okay. What exactly they are. Okay. Now, whenever you hear something about real asset, you have to think it like this. You are, the easiest example to remember is something which you can hold or something which you can see. But there's one exception over here, which is intellectual property. Okay. But the basic definition is you physically own or control it. Okay. These two properties should be there. Okay. You should own and you should be able to control it. Okay. Now either it can be physical or it can be digital format. Okay. Next is real estate. Within that, the first section is real estate, which is very simple. Okay. Normal investor like you and me, they also have a real estate part in their portfolio. Suppose if I'm having a house, okay, that is also a big component of my overall portfolio. Okay. So real estate is where the investment goes. The second is infrastructure. Now this is where generally institutional investors will come. Say for example, there is a company called Fire Capital. Okay. They will go and they will buy the entire, say, land parcel, or they will go and buy entire project of, say, airport. Okay, so Adani Realty, they purchased GVK airports, okay, GMR airports. So that is nothing but an infrastructure investment. Okay, so it can be bridges, airport, toll roads, utility. Now, why private sector is into this? Because government does not have that much amount of money. So generally, a lot of these projects are public and private partnership. Okay. Next is intellectual property. Now this is very easy. I have patents, I have copyright. Okay. I have a logo. Okay. I can use that logo or you use that content, okay, to generate revenue. Okay. So generally if you have patents, so if I'm a pharma company, I have developed a drug and as per law, I have 10 years to use it. Instead of me using that patent to produce, I can give it on rent to somebody and I can generate revenue. That is also possible. Okay, there is copyright rules. For example, J.K. Rowling's. Okay, she has a book, and on that copyright she has given the copyright right to filmmakers, and on that the film is made. Okay, natural resources, oil, gas, mineral, all of this gives you some amount of revenue also. See, oil, gas, and other minerals are very easy. Water also gives you a good amount of advantage if you have control over water. Okay, in certain area, then you can generate revenue from that. Other commodities, when you say commodity, okay, most of the time it is the agricultural good. Okay, rice, onion, all of these things. Okay, and metal. Now this energy is also highlighted here, oil. Okay, few of the examples are mentioned in this. It is the same thing that I basically talked about. It is the same thing. Look at the intellectual property. A musician owning the right to his song and earning royalties on that. This is where a lot of your singers also earn in India. Okay, a lot of lyricists might also earn in India. So all of these, right? Now think about this. It is not similar to a normal stock. Okay, it is not similar to a normal bond. Each asset is very different. So if I'm going to invest into these assets, I need to have good amount of knowledge related to that asset. So if I'm having a manager, I might have a manager only for real estate. I might have a manager only for infrastructure project, because each subcategory is unique asset class in itself. Okay, that's the broader intention of this this slide. Okay, different types of real asset. First, we are only going to focus on real asset. Okay, real estate, already we talked about this. Now historically in India also, a lot of these customers, okay, a lot of investors, basically they have been investing into real estate primarily because we were getting good amount of appreciation. Okay, land price always appreciates in India. This is one part, and because of that you generate revenue in price appreciation, and income. Because if I have the property and I can rent it to somebody, it can generate a steady cash flow for me. Very simple logic, right? And because land or these kind of assets, real estate, historically was there, okay, even before stocks and bonds came. So it has been popular since ages. It's a popular investment strategy for individuals since ages. Okay, what different types of real estate do we have? Residential real estate, very simple, you stay, it's a house, right? Commercial real estate is property. It can be hotel, it can be restaurants also, okay? Farmland, this is generally taken by companies, okay? They take acres of farmland and they produce, okay? For example, ITC in India, okay? Previously they had a plan of buying a lot of real estate, the farmland real estate, and produce their own crops, but they did not manage to do it, and then they tied up with a lot of farmers to manage their requirement for the raw material. Timberland, this is very interesting. You basically use land not to grow crops, okay, but to grow tree, bamboo, wood related products. So that is also used to sell. So you're going to be selling, you're cutting the trees, are going to be selling those trees, okay, for wood products. This is a very unique concept. Okay, imagine you buy a piece of land, over time as city expand, the value of that land goes up, and now somebody is interested to give a rent on that land also. Very basic, very simple, real estate as a concept. Look at this infrastructure project. We already talked about this, right? There are certain large scale projects where government itself cannot build anything. So they need people who can participate. So there are institutional investors who will put their money. And very, very popular of that is toll road. Okay, there are so many toll roads in India where you will, if you want to use that road, you'll have to pay some fee, 100 to 100 rupees. Okay, now what is that? The investor who had invested money into that project, he is generating return from it. Okay, airports and seaports, basically whenever a container will come, whenever a ship will come, okay, whenever a plane will land, they will have to pay a fees to that airport owner, right? Utility companies, electricity, water, these are nothing but in Mumbai you have Adani electricity, okay, so they have purchased that and now they're selling electricity to us, so they're going to be generating revenue through that medium also. Okay, utilities are certain things which are used by mass public. Okay, so gas companies, water companies, electricity companies, these are essential activity to run the city. Previously everything was government driven, but now private companies are also investing into it. So these are kind of alternative investment avenues for them to invest into these kind of securities or asset basically. If a private company builds a toll, it earns money every time the vehicle passes through it, right? And they will have the access to it for like 10 years, 20 years, depending upon the project cost. So they will generate a decent amount of return on that investment that they have made. Intellectual property, very, very interesting. This is one exception where we are saying it's a non-physical asset, right? I hope everybody has heard about intellectual property. One, patent, protection of new invention. Okay, so if suppose you have a Bluetooth technology which has been created by my company, I can either pass it on to other companies and charge a royalty on that, okay, or else I will use for my production only. Very basic, right? Second is copyright. This is generally there for books and movies basically. So you cannot pirate a movie because it's a copyrighted product. Trademark is related to your logo. So Coca-Cola, for example, Pepsi, they have their own logo, Nike. So I cannot use that logo and sell my product, correct? That will create a conflict. So they have intellectual property. They can sell this intellectual property because they've invested a lot of money to grow that brand. If an author writes a book, they earn every time somebody buys a copy. That is nothing but a copyright income. They get royalty. Okay. Natural resources. Okay. Oil and gas, which is coming from the earth and you are utilizing it. Minerals, gold, silver and iron. Very basic. These are used in industrial production capacities. Water and wind. Now these are used by companies like, for example, Suzlon. Okay, for them, wind energy, wind is an important ingredient because they produce turbines, right? So they are using that natural resources, okay, to generate some revenue. Okay. Similarly, you have hydro, which is water. If you have access to some water and you can create a dam and you can generate some electricity out of it, that is also possible. The company owns a land and underground there is an oil reserves. Okay, you can extract oil from that and sell it in the market. So you have the ownership of the land and also the underground asset, whatever is underground that land. Okay. Fifth is commodity. Now, whenever you hear the word commodity, one thing that should come to your mind is standardized goods. Mark this as star, standardized goods. Why? Because commodity is something which is very difficult for a customer to bifurcate. Say, for example, if you go to buy a rice, basmati rice in market, you would not know, you would not be able to clearly identify whether a basmati is from a particular company or not. Okay, so generally it's a standardized product. Okay, metal is a good example of that. Agri products. So whenever you hear about commodity, it is generally the agri product that we talked about. Energy, crude oil, natural gas, building material. These are just few examples, generally not testable in the exam, that what are different commodities. They might test you more on the understanding with respect to risk and other. Okay. Now mark this point as star. So in commodities, the way you can buy a stock, okay, you can also buy futures on a stock. You can also buy options on the stock. Similarly, for commodity, okay, it's an asset. Rather than physically buying a commodity, you can also go and buy an instrument on that. So you can have futures on commodities. You can have options on commodity. You can have ETF, exchange traded funds available on commodity. For example, gold ETF. If I do not want to purchase gold, physical gold, because if I'm going to purchase physical gold, I'll have to store it. I'll have to understand the purity of that gold. Okay, there might be some making charges. I don't want to have that. I want to avoid it. So what I will do, I'll go and buy ETF on gold, which is connected to the gold price. As the gold price goes up, the ETF will also go up. There's also gold bond of Government of India, which is on a similar concept it works. There's no need for you to physically hold a bond or hold a gold. Okay. So over here, look at the example. If you expect the gold price to go up, okay, easiest way would be to go and buy a physical gold. It can be coin or bar, or else you can invest through stock market. Okay, you can buy a gold ETF or a futures contract. Okay, I'm taking one more pause over here. Let me know if there is any confusion till this point, and if you're good, please mention yes on the chat. Okay, so let us move forward. I hope everybody is good. Now the basics are completed. Now within the real asset, we are entering into some interesting question. Why do people want to invest into real asset? And I'm going to mark certain points as star. So you will also have to make a note of it. Okay. So look at this part. They hold value over time. What does it mean? It is not a fad. It is not a fashion which is going to go out in the next 3-4 years, right? Something which has an intrinsic value. Like for example, if I'm going to have land or building, it is actually used to live. So there is a value which is there, right? And people will, even if you go 100 years in the future, there is still going to be need for houses, right? So these kind of real asset will remain valuable over a period of time. This is a very interesting point. Okay, steady income, because most of these assets give you rent, give you interest or some amount of revenue, because you can leverage that asset and give it to somebody else, like intellectual property, like patent. I talked about this, right? You're giving it to somebody else and you're generating revenue from it. Like the author of the book, he has scrapped the book. The moment it keeps on selling, it gives you revenue. Okay, very, very important part is hedge against inflation. Now this might not be applicable to all the real asset category. Very prominent example of this is real estate. That means I purchase a house today or a land today. With time, the value of that house is also going to go up, which covers the inflation aspect. Now, why this is important for an investor? Because if I am having 100 rupees and the asset is growing by say 3% and the value in next year is 103, and I am losing because of inflation. Inflation is 7%. So indirectly I have not made any money. In fact, I have lost money because of the inflation. Correct? So that is what the logic of a real asset is. It helps you to cover all 3 pointers. So mark them as star. Okay, why do people invest into real asset? And the example I talked about is this. Okay, property value, gold value generally goes up. Okay, and investor can protect against the erosion of value because of inflation. They can protect themselves over here. Okay, Varun, answering to your query, natural resource and commodity gold. So I'll just go back over here. What we are basically highlighting, that gold part. Okay, either you can physically hold gold, that is a normal way. You can make jewelries and hold it. You can have coins, you can have gold bar, or else, okay, you can basically invest, take position into financial market. You can go to stock exchange. There are futures available, futures on gold available. There are ETFs on gold available. These are financial instruments available on that underlying asset of gold, which is dependent on the price of gold. So instead of physically buying, you can hold it in a digital format. Right, Varun, I have answered your query. All good. So mark this 3 points as star. I'm going to move ahead now. Hedge fund and private equity, second and third category together. Okay. Hedge funds. You must have heard about it. A lot of people are working in hedge funds also, right? Hedge fund is nothing but a pool of money. Okay. Where suppose the ticket size could be like 5 crore, 10 crore rupees. Okay. So over here, it is going to take a lot of time for the investor to generate returns. So what they do, they pool in the money, okay, and it basically there'll be a fund manager who's going to invest on your behalf, okay. They're going to be investing on their behalf, and this manager is the fund manager. He's also going to get an incentive. He's also going to get an incentive based on how the fund is performing. So he's going to use extraordinary strategies. He's going to use leverage. That means he's going to borrow money from outside, okay, and invest into the strategies. He can also do short selling. Short selling is risky, okay. When you do short selling, you expect the price to go down, okay. But if suppose the price goes up, you're going to be losing money. So normal mutual funds, they don't do that. Over your hedge fund, because they want to generate return and they're less regulated, they have the opportunity to invest into these kind of strategies also. They also invest heavily into futures and options, okay, futures and options, okay. So this is kind of an introduction of hedge fund. Again, like I said, there's a full-fledged chapter on hedge fund which will go into the details of these strategies, okay. Few important points. I'm going to mark this as star. They are less regulated. Why less regulated? Because the money of generally ultra-rich HNIs who are financially sound or who have knowledge about these instruments, they invest into these products. So government and the regulators are not very much interested in protecting them. They're more interested in protecting the normal investors who invest into stock market, and the retail investors, they are more interested. So if you go and buy a mutual fund, there's a lot of restriction. But for hedge fund, if you're going to invest, the restriction from the government side will be very less. Okay. Secondly, it allows more strategies. Why more strategy? Because in traditional asset like mutual fund, or say a stock or a bond, you might not be able to exploit for bigger returns. Okay, so if I am an investor, I have a very low risk aversion. That means I am willing to take high risk. Okay, over here I can use hedge fund strategies to generate extraordinarily high returns because I have the appetite to take risk. Okay, so kindly read till this point, everybody. All good? Varun, I generally don't give permission to talk directly in between because it creates a lot of noise from outside in the recording. So don't worry, at the end I'll be opening up the avenue for all of you guys to talk. You can make a note of it. Sure? All good? Now over here, short example of how hedge fund can take strategy. Okay, few of the strategies are mentioned and what is an example. Suppose there is a company, Technova, which generally we expect it's an IT company and there is some news about it and we are expecting the price to go down. Okay, now if I am a mutual fund manager, I might not be able to benefit from it because I know that the company price is going to go down. But in India, regulators are saying you cannot take short position. But if I'm a hedge fund manager, I can profit from it. I can take a short position at 1,000 rupees. Okay, when the price goes down, say for example at 800, so I've already sold at 1,000, I'm going to buy at 800. The difference between that is the profit that I'm going to make. Okay, in normal trade, what happens? You buy at 800, you expect the price to go at 1,000, and then you sell. Over here, exactly same thing is happening. Why? Because you're selling at 1,000 and you're buying at 800, but you're selling first. Okay, you're selling first. That concept is called as short selling. Now, what is the risk? Very simple risk is if we are expecting the price to go down, but if the price goes up, then there is a challenge. Okay, because then I will have to buy back at a higher price. Think about this. I've already sold at 1,000. The price went to 1,300 and I have to buy back. Then I'll be in loss. Correct? I'll be in loss. Answering to the query, Tejas, futures and option are again done on stock market. Yes, you have futures on Reliance, Infosys. That's correct. Which is again a traditional investment. Then how it can be alternative investment? No, you're not understanding. The underlying asset is changing. Okay, future or options are just a medium. When you change the underlying asset, okay, what they are saying is instead of directly buying a alternative investment, you can buy through futures or options. Correct? So you think about this. Futures on Reliance stock, futures on, say, a commodity. The underlying asset is different. That is why we mentioned over there. Right? Okay. These are few examples. Few examples of the strategies, which in that chapter it's going to be detailed. Look at the first one, managed future funds. Now, what is happening over here is these type of hedge fund strategies are slightly limited because what they will have to do is they will have to have models available to predict, okay, what is going to be the price of onion after 3 months. Okay, so they take a lot of historical data, they have a lot of variables, they create models to identify what is going to be the price of a particular asset. Mostly it's going to be commodity. Okay, most of the time it is commodity. Okay, and then on the basis of that they will take position. If you expect that the price is going to touch X amount after say 6 months, you start buying right now in smaller quantities. That is managed futures. Basically, you're betting on the future value and you're betting that your model is going to predict that future value properly. Second is event driven. This is very interesting. Okay, which is most of the time if there is going to be a merger or acquisition. Okay, a very simple example of this is merger. So if Kotak Bank is going to merge with ING Vysya, okay, the moment they announce that okay, we're planning to have a merger, there are a lot of process that has to be followed. Board has to approve, both the company's board, then the shareholder has to approve, then the government has to approve, court has to approve. It takes a lot of time. Okay, now if suppose Kotak has decided that okay, I will merge at this price. Okay, so immediately the price of ING Vysya will not touch at that level. Say for example, Kotak has decided that okay, I will buy ING Vysya at say 50 rupees per stock. Okay, and current stock price is 30. Okay, you have to think it like this. Okay, if the merger is going to happen at 50 rupees per stock, what is the current price? Current price is 30. The moment the merger news will come or the acquisition news will come, this stock price will jump. Why? Because now market is anticipating that this merger is going to happen till it has not been completed because there can be so many problems into that. Okay, so it will jump from 30 to say for example 40. I'm just taking a hypothetical number. Okay, and market is waiting now to complete the merger and then it will touch 50. Why it will touch 50? Because there is somebody who's willing to pay 50 rupees to buy that company. Correct? So a hedge fund would say for example enter here. Okay, and he will wait for that 5, 6 months, 7 month time frame. He will take that risk. He will buy huge quantity of that company. And the moment the merger gets completed, the stock price jumps to 50, he will sell and he will exit. Okay, that is nothing but event driven decision making or event driven strategy. Okay, similar to this, if suppose you have a news, you have an understanding that this particular company is doing bad and you expect some bad news to come, okay, because of the market environment, and you expect the price to go down, you will immediately go and take a short position. Okay, I hope everybody is clear. Vibha, answering to your query, I'll go back to the slide. Answering to your query. So the question is it's a relevant question. How can I sell something? We were talking about short selling. How can I sell something if I do not buy it first? So generally this happens via borrowing. There is a broker sitting in between. He will borrow that security he will lend that security to you. You have borrowed it and then you've sold it in the market. When you buy back, if you've sold at 1,000, you purchase back at 800, you're going to give that stock back to the broker. Correct? Vibha, I've answered your query. Event driven funds. What is global macro funds? Over here in the global macro funds, there's a concept called as mean reversion. Okay, what is mean reversion? So suppose if this is the long run average of say interest rate, okay, in a particular country, and this is say around at 7%. Currently the interest rate in that country is say 10%. Okay, so generally interest rate, inflation, currencies, they follow a logic of mean reversion. That means you will come and touch the average, but you don't know when it is going to happen. So this 10% will come and touch that 7%, then it can go either up or down, we don't know. Okay, but what we are betting on, that it will come and touch the average. Now this might happen in the next 5 years, 6 years, 10 years, you don't know. So global macro funds, they bet on this. Okay, they bet that, okay, if the interest rate is higher than the average, it will come and touch. Okay, if it is below, it will go up and touch. So if you will take positions accordingly. Okay, I have given you an example of interest rate. It can also be for currency. It can also be for inflation, other macroeconomic variables. Okay, I'm taking a pause. Any query, any confusion till this point? All good? Tarunesh, these PPTs I'll be adding into the web access. You can access it through your browser later on. As I keep on completing lecture, I'll be adding it. Okay. Varun, answering to your query. So what is global macro? So you bet on macroeconomic trend. Okay. So what is the macroeconomic trend? Currently the rate of interest is 10%. You believe that the trend is going to go down. So you will take position accordingly. You believe that the trend is going to go up. So you're going to take position accordingly. Right? I hope everybody is good. I'm going to move ahead now. Let us move forward. Different types of private equity, and what exactly is private equity? Private equity is nothing but I'm buying the equity, which is stock, but of private companies. Okay, why? Because these companies need funding to grow. Okay, they also want to invest into R&D, invest into new plants. Okay, so private equity investments help them to do it. So a lot of time when we see these startups are saying I am valued at this amount, they are basically getting money through private equity. Currently they are a private limited company. They are not listed on any exchange. Okay, so they basically sell their stake at a particular valuation and get money to grow their firm. Okay, so a lot of time you'll find Indian startups have raised X amount and all of that is coming through this. Okay, so what are the different types of investment strategies? Venture capitalist funding startups, right? So VCs are generally going to enter into the startup life at a very early stage, where they might have some product available, they might have some concept available, they have just started generating some revenue. Okay, now over here venture capitalist fund, they will take the opportunity, they will understand what is this business about, and they will invest heavily. Over here the risk is very high, okay, and the reward is also very high. There are a lot of investors. In fact, there was one investor in Ola. Okay, he is a way too early investor into that company. Now the Ola is so big in India, so he is generating 1,000 times, 500 times return. Such a huge investment return for him. Okay, so they enter at a very start. Okay, they get equity ownership. That means they take the risk. When I buy a share of a company, I am the owner. If company goes down, I will also lose money. Correct? So they invest as an equity holder, and they take the risk because they understand if the company does good, I'm going to make huge returns. Okay, so venture capital firm invested around 10 crores in a company called SmartPay, which is a fintech company. Okay, and if the company becomes very big, unicorn, okay, say 1,000 crore valuation, then the venture capital is going to make huge profit because his stake, the value of that stake he has got 1%, 5%, 10%, that is also going to be very big. Correct? So that is the idea which is here, which is private equity. So first we have read about this venture capital. Okay, they enter at a very early stage. Okay, then you have growth equity. Now the company has been growing. Okay, they have been able to generate revenue, they have been able to prove their model. Then these growth equities will come and they will invest into the company. Okay, which is here. Check this. Now the company needs money to expand. Okay, they have already have a proper model available. They want to grow fast. Okay, so most of the time these growth equity people, they generally invest 5-6 years before the IPO. Okay, now they are taking risk, but they are taking lesser risk than venture capital. Why? Because if I'm a VC and I've invested into a particular company, I don't know whether this model will be successful because I'm entering at a very early stage. Okay, I'm betting more on the founders, I'm betting more on the concept. But over here, growth equity investor, he is going to invest more from the perspective of he has more confidence in the business idea because it is proved, and then he is investing, so his risk is lesser. And what he sees that, okay, now I'm going to invest in the next 5-6 years, IPO will happen and I will exit from the company at 10x valuation, 5x valuation, whatever it may be, 5x returns. Okay, a clothing example which I've got from the internet. Okay, wants to expand into international market. So if you have seen Shark Tank, okay, a lot of the companies who are coming over there, they are looking for growth equity. They already have a business running, they have proved most of the time, and they are expecting money from sharks to grow into different market, different businesses, different products also. So they are expanding. Okay, very simple example of this would be expanding into international market. So they need funding, they need expertise also and funding also. Right, that is nothing but your growth equity. Okay, last and very, very interesting, we can mark this as star, leverage buyout. Now what is this leverage buyout? So what is leverage? First understand that word. See, leverage means I am using somebody else's money. Okay, so Shubham, suppose you have taken a home loan, okay, and the property value is 1 crore rupees INR. You have 20 lakhs available, you have taken 80 lakh rupees loan from HDFC Bank. So when you're taking that loan, you're actually taking a leverage because you're using somebody else, that is bank's money, to buy an asset. Okay, so in leverage buyout also the same thing is happening. Okay, you're buying a company but not with your own money, you're buying it from the borrowed money. So very simple example, suppose all of us are on the board of ITC. Okay, ITC is a company, it's a tobacco company in India. They have a cash, it's a cash rich company. Okay, now all of us are running the company. Okay, we might not be the owner, but we know how the company operates, what is the cash flow, everything we know. Suppose we all decide that let us borrow money, we put our money also, let us also borrow money from a hedge fund, for example. Okay, some 700, 2000 crore rupees, we borrowed it and we decided to purchase this ITC company, Indian Tobacco Company. Okay, we decided to purchase. Now the hedge fund is going to ask you, how will you repay me? Right, so you have a very easy question. You say that, you have an easy answer. You say that whatever is the, once we become the owner of ITC, the cash flow is for us. We will use that cash flow to pay back the debt that we have taken from hedge fund. Okay, and whatever is the value, whatever is the asset of ITC, that will be used as a collateral. Whenever you take any loan, there's a collateral that is there, no? So this property of that ITC company will be used as a collateral. So you, me, everybody, we being a board of members, board of directors, we are using somebody else's money to take control of the company. Okay, take control of the company. Okay, so borrowed money or an investor's fund, most of the time it's borrowed because the name it's leveraged buyout. Okay, they use the company's asset as a collateral for the loan. Like I said, they will say to ITC, they will say to hedge fund that don't worry, your money is safe because whatever is the asset of ITC company, it will be used as a collateral for your loan. Okay, generally this happens when the company is not doing good, and you being the person who is managing the company, you have in and out understanding about it. So you know that if I get control over the company, I will be able to run it properly, and once it is stable, I will sell it to somebody else. So that is also possible. You can sell it back or you can take it public. You can take it public. Look at this example, everybody, and I'll answer the query. Prachi, who can invest in venture capital? It's an institution or common people. Like generally it's common public. Okay, common public means HNIs who have capital available. You and me will not be able to invest into VC fund because the risk is very high. So you will find Kunal Shah from Cred. Okay, he is investing. Ashneer Grover. Okay, he has a lot of capital available. He might have his own venture capital fund through which he will invest. Right, Prachi, I've answered your query. And I'm going to take a pause. Any queries till this point? Jash, Guru, Varun, Vibha, Nani. All good? Wherever I'm marking star, please make sure that you underline it in your book or mark that concept as star. Okay. Next, within the LBO, okay, also mark this as star. Management buyout, management buy-in. Now, see, the concept is not very new. This is happening in the market for the last 30-40 years. Okay. The existing management take over the company. Do you realize the ITC example that I talked about? We are the management of the company. We were running the company. We borrowed money from outside and we took the control of the company. So existing management takes the company's control. They become the owner of the company. Okay. There's a famous case of KRK and RJR Nebesco, which is a US company, which was a leverage buyout. There's a book also on that. Next is management buy-in. So generally, suppose if I'm a hedge fund, okay, I want to take control of a particular company. Okay, I can buy that entire company. Okay, and I can bring new management. Okay, so why? Because old management might not be able to grow the company. So we are removing everybody and we are getting a new management to run the company. Okay, and I'm going to take debt. So very simple example of this would be when Elon Musk purchased Twitter. I think so he got $20 billion worth of debt from big banks. He invested that into the company, he changed the management of the company. Okay. Look at the example. Dell, we all have heard about this company. Okay. So the founder, see, Michael Dell, okay, it was a listed company. He partnered with Silver Lake Partner, which is a fund. Okay, they have capital available. And what they did, they took a loan of around $24.4 billion. They took the listed company to a private company. How come it is, when it is listed, the shares are available to the normal public? If I buy back entire shares and I have now 100% ownership of the share, it becomes a private company, right? So in India also DLF has done that. Dell is a very good example. Now why do you want to move from being a public limited company to private limited company? Because one of the strongest reasons is that when you're a public limited company, you have so many compliances. You have to inform everything to exchange. You have to inform everything to ROC, registrar of company. Okay. Any small change you have to update, you have to file. So there is a lot of public scrutiny what this company is doing. So you might not be able to run the company properly. Okay. So that was one of the reasons why Dell went initially from private to public and then again went public. So they wanted to structure the company properly and then take it to public. Okay, that is the point. Marks are the special types of LBO. Shubham, answering to your query, why do funds use debt in case of buyout? Why can't they purchase the entire thing in equity? No, Shubham, so what is happening? I want to purchase the company. I am borrowing, I am taking loan from outside. Okay, I am taking the equity of the company only. But I am borrowing from outside. Right, Shubham? All good? Look at this example. So this was an example of management buyout where the existing management, who was the existing manager? Michael Dell. Okay, he purchased the entire company from public to private. Look at this, management buy in. In 2025, there was this capital company. He took. I know you must have not have heard about this company name. It's an example from US market. Okay, so they basically had a deal of around $5.3 billion. Okay, where they purchased the company and they removed the old management. They wanted somebody with a fresh idea who can take the company to new heights. So they brought a new management into the game. Okay, management buy-in. Very, very simple example of this. Okay, let us go forward. This is basically a summary. This is basically a summary of all the discussion that we had. Okay, difference between hedge fund and private equity. Okay, I've added it at the end in some sections so that you can just quickly read this and understand it. Okay. We're going to be entering into private debt. I'll address the query. We must pay high interest in this case if we are borrowing the money from. Yes, definitely. But you know now that, see, if you invest that money into the company and take control of the company's share price will go way too high. So you are willing to pay that high rate of interest. There is no problem with that. Right, Prachi? Types of private debt. Please remember, when we say private debt, you're taking a loan, but not from a bank or a financial institution. Okay. Direct lending. Types of private debt. Private loan instead of bank loans. Okay. Historically, what used to happen is whenever businesses need money, they used to go to a bank. But the problem with banks is that you have a lengthy process. They will need a lot of documentation. Plus, they will do credit assessment of your company. Now, a lot of companies might not have a very strong cash flow. Okay, suppose they are already in losses and they need money. So if they go for a bank, they will not get the money from the bank because bank will easily reject it. Okay, so this is the first problem. There are certain companies who do not have a good history, but they still need money. They go to private debt. Second, a lot of time it takes the process of getting a loan from a bank or a financial institution is too tedious and too lengthy. Private debt is going to be faster because you don't have to explain everything to them. Okay, because they will also get high rate of interest now, right? So lending money directly to business instead of banks doing it. Okay, who are doing this? Okay, these loans are often made by private equity funds, hedge fund. There are private credit funds also. When we say private debt, most of the time the discussion is about private credit funds. It's a pool of money, but they're investing that money for giving loans to companies. See, your private equity, your hedge fund, everything is pool of money. Okay, there are rich, ultra rich HNIs who have 50-60 crore available. They are putting it into the pool. Okay, similarly over here also, this private credit, it's a fund where a lot of people have come together. They have invested money. Now this fund is going to give loan to companies. Okay, it is much quicker to take loan through a private debt as compared to a bank. But the problem is high interest rate. So remember this point, high interest rate and faster. Look at this example. Zendesk, a software company, was taken private in in a $10.2 billion deal. Okay, where the entire financing. So they purchased the company, but they took a private debt from a private credit fund instead of going to a bank. Okay, so out of the 10.2 billion, $5.3 billion was through debt financing. Okay. Last few pointers which were there in the book also. Private lenders fill this gap. Why? Because there are a lot of companies who might not be eligible to get a loan from a bank. So this is where the private lenders comes into picture. But the problem is they charge a high rate of interest. Okay, I'm going to take a small pause, read till this point. Let me know if there is any confusion. All good? What are the different types of private debt investment? Okay, see this distressed. Distress means you're already in problem, right? So there are companies who are at credit rating of say CCC, CC, and who are very low in credit rating. They might end up facing a problem that if tomorrow there is one big bad news in the market, or suppose one of the product fails, they'll go into bankruptcy. Now bankruptcy means you are saying I do not have any money to pay my creditors. So you'll have to sell the asset of the company to pay the creditors. Okay, so there are a lot of companies who are already into that pre-bankruptcy phase and they need funding. Okay, or else they will go bankrupt. Okay, so distressed debt are these kind of debt where they will look for these companies, okay, and they will invest into the company most of the time to take control of the company. Okay, control in the sense that they can participate in the decision making. Say for example, there is a company which is which is a triple C credit rating and not doing good. I, being an investor, I have given money to them as a debt, but I have signed an agreement in such a way that I get the board membership. Okay, I get an authority to have a voting right, some level of voting right. Now, because of this, what will happen when they are basically taking a decision to turn around the company? I will also participate in that. Okay, the idea over here is that we invest into these companies which are about to fall, invest heavily, take control of the company, turn them around, and the company goes up, sell at a very high price. Okay, and because the company is not doing good, when you are investing money or when you are buying the debt, you will get the money at a deep discount. You will get the bonds at a deep discount. Okay, so there is high risk, okay, but also good chance of high return because you're buying at a deep discount. If the company turns around, then you are going to make huge money, right? A lot of time they enter into the structure as convertible debt. What is convertible debt? So I will give you a debt now. After 2-3 years, it will be converted into equity. I'll become the owner. Okay, so a lot of these investors, okay, they enter into this because they know that initially I've given you a debt. Okay, if the company turns around, I'll convert it into equity and I'll become the owner also. I'll be able to earn from that growth. That is the idea. Okay, you can read this example. US hedge fund Elliott Management acquired hundreds of millions in Thames Water debt. Okay, how much? £3 billion emergency loan had given. Okay, this is nothing but a distressed debt that has been given to a financially troubled company. Why? Because they were thinking of restructuring the entire company, okay, turn it around and sell it later. Okay, there are all simple more examples. Say suppose there is Bharat Steel, which is not doing good. Okay, now as a company, as an investor, if I enter and I give distressed debt, if this company recovers, okay, and the company goes up, obviously the bond value will go up, I will make huge money. But if the company goes bankrupt, I will basically, my debt will be converted into his shares. Okay, and I will control the company and I will try to take some of the assets of the company and use it somewhere else. That is a broader view. Okay, distressed debt is there in the market. There are so many people who do that. So many funds who do that actually. Structured product. Now, this structured product will come again in detail in one of the chapters in, I think so, book 2. Okay, where the focus is on a very good example of this is your MBS, mortgage-backed security. Okay, so what is the general name? I'll give you a gist. This topic is not in detail about it. So I'll give you a gist. There's a concept called ABS, asset-backed security. Suppose I have a pool of asset. Okay, this asset is generating cash, generating returns. I will create an instrument on that pool. Okay, that is ABS, and I will sell this ABS to investor. Okay, when the investor buys this asset-backed security, whatever the pool is going to generate return, it will go to him. So I'll give you an example. The concept is called as MBS, mortgage-backed security. Okay, suppose there is a company, Citibank. Okay, Citibank is giving a lot of loans, home loans. What they can do, there are certain home loans which are good home loans. They want to keep it on their books. But there are certain home loans which are risky. So what Citibank would ideally do, okay, they will pass those not so good home loans to a special purpose vehicle, which is nothing but a company. Okay, they will sell this, their own company, sister concern company. They will sell that entire pool of say 10,000 home loans. Okay, to this special purpose company, and this company will pay them money. Okay, now this special purpose vehicle, what they will do, they will create an MBS product. Okay, generally MBS is a single product. Okay, and they will sell it to investors. They will get the credit rating agencies and all involved, and they will rate this MBS and they will sell it to the investor. Now, what is interesting happening over here? Okay, investors who cannot directly take access of the home loan market through this process of MBS, they are able to get access to that pool of 10,000 home loans. Okay, and whenever these home loans, the people who are staying in this home, they are going to return, they are going to pay EMIs. That EMI will go to the investor. So this is the return of their investment, right? And what is the benefit of Citibank? In simple language, Citibank has been able to remove all the slightly higher risky loans from his book, and he has got the cash back, so they can give more new loans in the market. Okay, this entire process is called as securitization. Okay, MBS is one example. What is MBS? Mortgage backed security. Because the pool that I had created, that pool is of home loans, mortgages. You can similarly create collateralized debt obligation, where the pool is made out of corporate debt, corporate loans. Okay, so there is CDO, which is corporate debt, CLO, collateralized loan obligation, that is also there. Okay, which is made out of corporate loans. Basically, the pool is changing, but the process is same. Okay, process is same. So these structured products are special type of investment products, where if I am an investor and I want to take an exposure on, say, corporate debt, there are 500 corporate loans. Okay, there is a pool of that 500 loans, and I want to take an exposure through this structured product. I can take exposure, and there are different types of investors who want different type of returns in the market, so they are enter into this through a structured product. Okay, there is a concept of cash flow. Okay, so I didn't talk about this explicitly, but suppose this is a pool. Okay, instead of selling one security, I am selling three different type of security: senior, mezzanine, equity. Okay, senior will give a return, say, of around 3%, mezzanine will give 7%, and this will give 15% return. So depending upon what type of investor I am, if I want to take high risk, okay, I will buy equity tranche. If I want to take low risk, I'll take senior tranche. Okay, because when the cash flow is going to come, when the principal amount is paid from the pool, first it will go to the senior tranche. Then once the senior tranche is entirely paid, it will go to the mezzanine tranche. Once the mezzanine tranche is entirely paid, they will go to the equity tranche. So if I am an investor and I have purchased a senior tranche, I'll be paid first. So my risk is low, and hence my return is only 3%. Correct? But suppose if I am an investor who has purchased equity tranche, my risk is very high because I'll be paid last, and hence my return is also very high. Okay, so they can divide the cash flow, okay, depending upon what is the need of the investor. Okay, certain investor want to have a lesser risk, certain wants higher risk. It all depends upon that. So look at this example also. Okay, we have created a pool of 1,000 home loans. Okay, and that pool is basically sold to the investor through a CDO or a CMO. Likewise, collateralized mortgage obligation. There are a variety of products, okay, which are there in this entire securitization market. Okay, and each type of asset will bring a different type of risk. Okay, you can read this credit derivative. Okay, very good example of this is CDS, credit default swap. Now you can think of credit default swap as an insurance. Okay, it is nothing but, suppose if I have purchased a bond, I'll give you an example of CDS to connect. Suppose Mr. Tejas, you there, right? Tejas? So Mr. Tejas has purchased a bond of Yes Bank. Okay, and this bond is for 10 years and he has purchased it for $10 million. Okay, now after few years, there's some bad news about Yes Bank, and now Tejas is worried. He doesn't want to sell the bond, but he is worried that there is a credit risk. Yes Bank might collapse and I might not get the money. So what he can do, he can basically go to AIG, American Insurance Group. These are called monolines. Okay, he can basically buy a CDS. credit default swap. Okay, and when I'm going to buy, I'm going to pay premium. That premium is called as CDS spread, basic insurance premium. Okay, now in this contract, what is written? In this contract with AIG, it is written that the reference entity Yes Bank, if anything happens to that, there's a list of credit event you will have to write down. If any of these credit event happens to this Yes Bank, then AIG will pay Tejas $10 million. Basically, it's a protection. So whatever credit risk you're facing, you're taking an insurance on that credit risk. Okay, that is nothing but your credit derivative. So you're transferring your risk to AIG. I'm taking a pause. I'll also answer the query. Prachi, answering to your query. Is it same process where Lehman Brothers bankruptcy happened? Yes. So securitization as a process was one of the reason because of which 2007 and 8 crisis happened. That is correct. MBS, CDO, CLO, all of these concepts are connected to that also. I'm taking a pause. Any query, any confusion till this point? All of this will get covered more in detail in the further chapter. What will the AIG get? AIG is the monoline. He is giving you insurance. He is getting the premium. Right? He is getting the premium. Same with the insurance company. They give you insurance and they get the premium. Correct? Why do investors prefer private debt? High returns. See, if I'm investing into a private credit fund, who's going to give private debt? So I am an investor into that fund, correct? And I know that this money will be used to give private loans. So I know that there's going to be high return. Secondly, diversification, because this fund, suppose the fund is 10,000 crores. It is going to give loans to hundreds of companies. So it is diversification. Why? Because one or two companies might fail, but everybody might not fail. Secondly, I am an investor and I'm putting money into this private credit fund along with stock market. So what is happening? I'm getting a stock market exposure also. Okay, but this private credit fund is not connected to stock market, because if stock market goes up and down, it is not going to impact the loans that I have already given. Okay. Similarly, control and influence. Like I said, in certain cases which is specific to your distressed debt, okay, you will find ownership of the company. That means I have given a debt in such a way that I am able to take decisions of the company. Okay, so you can convert your debt into equity. Okay, I'm taking one more short pause. Read this paragraph. You can mark this as star. This is kind of a summary. Okay, answering to your query, Shubham. First lien, second lien. Suppose if I've taken a home loan, okay, no, not a home loan. Suppose if I've taken an educational loan and I've kept my home as a collateral. So whichever company has given me the education loan, they will put a first lien on that property. That means they have the first right. Now suppose on that same house, I've taken a personal loan also. So they will put a second lien on that home. I hope I'm clear. Shall we move ahead? Few questions I want you guys to answer and fast. Chalo, first question, quickly. HSBC is a bank. Read everything. The bank's risk team is evaluating the potential risk associated with infrastructural investment. Okay, infrastructural investment. One of the primary concern, they are looking at primary concern, okay, is the mismatch of assets cash flow and the financing structure. Which of the following risk is most critical in this scenario? Chalo, fast. Do you have commodity price risk? No, because it's an infrastructure project. Is interest rate a problem for me? Could be a problem. Why? Because I'm going to develop an infrastructure project. I have borrowed money on loan and I have to pay interest. There could be a risk. Okay. Liquidity. See, possibility that investment cannot be easily sold or exited. See, this will only come into picture. This is not the answer. This is not the answer. This will only come into picture when the infrastructure project is completed. Right? The answer is B. Regulatory. Why? Because you're dealing with government. If tomorrow the government changes, the policy changes, then what will you do? This, whenever you enter into infrastructure project, the major problem is government. Government change in rule, or they might add new tax, something like that, which is going to impact your business. So answer is B. Okay, we have given the reasons also, you can read it later on. Look at this question. Fast. A leading private equity company is evaluating an investment into a mid-sized European company. The company has a stable revenue, well-established market, and seeking additional funding to expand. What is going to be the situation? This is easy. If you want to expand, you're already well established, then it is going to be growth equity, no? Growth equity. Easy. Let us look at this third question. JP Morgan is considering an LBO of publicly listed firms. The deal involves substantial debt financing and the firm plans to improve efficiency to increase cash flow. However, the firm has a significant portion of intangible asset and its current leverage ratio is already above the industry. What is leverage ratio? They've already taken a huge debt. The company has already taken huge debt, which is higher than the average in the industry. Which of the following is the biggest risk to the success of this LBO? Very interesting question. Chalo, read. So, risk of operational improvement. So, this problem will come when you start working on the deal. Correct? You have got the deal. Now you want to improve the company. You might fail in that. That could be one risk. Correct? Potential regulatory scrutiny. See, by reading this, you don't come to know that regulator is actually involved. So, this is wrong. C is also wrong because operational efficiency part will come later. Okay? Now, either high debt or intangible asset. Use of intangible asset is a collateral for debt financing, not necessary. See, there are a lot of intangible asset which has value in the market, which you can use. Okay? The major problem is high debt, and they have explicitly mentioned it is higher than the industry average. Correct? Answer is A. Look at the next question. Read it fast. Senior investment manager at ICICI Prudential is considering an opportunity to invest into structured credit backed by diversified pool of mid-sized corporate loan. There are multiple tranches with senior tranche. We talked about this, na? Senior tranche getting lower interest yield. Okay, there are junior tranches which gives you higher return. Junior means mezzanine and equity tranche. Which type of private debt investment is happening, which we are talking about? This is easy. Right now? This is going to be collateralized debt obligation. You have a pool and on that you have created four different instruments. Answer is A, collateralized debt obligation, right? Let us go to the next learning objective, which focuses on asset classification. Okay, demonstrate the knowledge. Over here, some specific aspect is being highlighted over here. Okay, how we are basically trying to understand how alternative and traditional investment actually work and what is the classification that happens. Okay, now some points are very interesting because there are certain assets which are clearly into alternative, okay, but there are certain assets which can be into alternative, can be into traditional also. Okay, some investment can fall into both. Okay, why is it difficult for you to classify some? Okay, read this line. Some investment don't neatly fit in either this and this because of their characteristics. This is very important because of the characteristics. Look at the example. Okay, REITs, Real Estate Investment Trust. Very simple example of this would be, suppose there is a mall in Dubai. Okay, you have listed that mall on an exchange and you have sell shares of that mall. So whenever the mall is going to generate rental income, you will get returns. That is called as Real Estate Investment Trust. Now, do you realize the moment it gets listed on an exchange, okay, it is kind of a traditional traditional investment. It is not a normal real estate investment because when you list on a exchange, you have liquidity. You have the stock of that mall, you can sell it to somebody else. You have the shares of that mall, right? You can sell it to somebody else. So, look at both the points. If I directly go and buy a real estate property, it becomes an alternative investment. But if suppose I'm buying a share of real estate investment trust, then it is a traditional investment because I'm actually buying a share of that mall. I'm not buying a property in that mall. Correct? That is a very, very interesting point. So you can mark this as star. Okay. Moving ahead. Challenges in classifying different type of asset. Okay. Now over here, listen to this carefully. I'm just going to zoom in. Okay. So real estate can be traditional or it can be alternative. How come? See, we talked about this. If I'm going to invest into REITs, it is traditional. If I'm going to directly buy, it is alternative. Similarly, look at this, natural gas. Okay, natural resources. For example, oil, gold and all can also be alternative or traditional. Say for example, I am buying a metal directly, then it is alternative. But suppose I am buying shares of company who's dealing into metal, then it is traditional. Then it is traditional. If you're buying share of Gold Miner Limited, a publicly traded company that mines gold, it is actually a traditional investment. Even though you have an exposure to natural resources, it is a traditional investment. Okay, one more example, Hindustan Zinc. It's a company, Indian company, right? If I buy the shares of that company, it becomes a traditional part. Even though the company is extracting and selling minerals. Okay, but instead of that, instead of buying the shares, if I had direct ownership of any natural resources, then it becomes alternative. A good example of this would be farmland. I have purchased a farmland and I am using it to invest or basically to grow. Then it is an alternative. Okay, I'm taking a short pause. Any query, any confusion till this point? Any query, any confusion till this point? All good? So first challenge that we talked about is this, okay? Now look at hedge funds. Hedge funds are usually alternative investments because they generally take high risky positions, they have complex strategy and all of that. Okay, but look at this. Some mutual fund copy hedge fund, alternative investment funds in India, AIF. So they are managed through mutual funds, okay, but they invest into alternative investment assets. They don't invest into traditional. Okay, so what is happening? They're copying the hedge fund strategies, but within the government rules and regulation. So if I buy a mutual fund which mimics an hedge fund strategy, then it is traditional. But if I directly go and invest into hedge fund, it is alternative. Interesting? Private equity. Now this is also, there is also variation over here. Okay. Private equity investments are generally considered as an alternative, but there are some closed-ended funds. Closed-ended funds are mutual funds. Okay. Where they are similarly copying or they are investing as private equity fund. Okay. And they buy stakes of private company. So if I'm investing through mutual fund in a closed-ended funds structure, then it is a traditional investment. You can read this. Look at this example. I've tried to get some examples from the online part. Okay, Blackstone Strategic Credit Fund, AMC's HDFC also has some private credit investment fund. So if I'm buying through them, then it is traditional. But if I'm directly investing into a private equity fund, then it's an alternative fund. Okay. Similarly, let us look at private debt. Okay. If it's a bond ETF, so there is a ETF, the way you have ETF on gold, you also have ETF on bond. Okay. Then it is traditional. But if I'm directly investing into LBO, right, distressed debt, all of these structured product, then it is an alternative part. Right. So you can have derivatives. So ETF is kind of a derivative. Okay. Which copies the traditional assets, then it becomes traditional. Basically, you have to think it like this, that whether you're directly investing into a private debt fund or else you're investing it through something which is listed, okay, then it becomes traditional. Okay, so on all the four examples, the core concept is same. Trying to understand whether it is traditional or alternative. Okay, there can be some complex strategies, okay, which brings you higher risk and it needs specialized knowledge. See, when you invest into private debt fund, you need a fund manager who knows a lot of things that are there happening in the market. He needs to know which company I should give loan, right? So it's a specialized knowledge. Without that, the fund will break. Okay, so over here, if I'm directly investing into these kind of private credit fund directly, then it is an alternative investment asset. Okay, summary is here. Whatever point we have talked about, all of them has both the characteristics depending upon how you are investing. Okay, I'm taking a pause. Any query, any confusion till this point? Yes, it will be added into the website. Let us move forward. Let us look at this question. First question, chalo. Rajat, an investment analyst at Kotak Wealth Management, is evaluating a fund that provides exposure to real asset. The fund primarily invests into commercial properties through publicly traded structure. See, publicly traded structure. So you are getting an exposure to real estate, but through publicly traded structure. Okay. What is this investment called? This is easy. Come on, guys, fast. Yes. So you're buying real estate exposure through REITs, and it is a traditional investment asset. Answer is B. Perfect. Look at the second question. Amit Desai, a high net worth investor, is considering various investment options. He is evaluating three potential. First, directly buy the share of DLF company. It's a publicly traded company. It's a listed on the exchange. Or else purchase the REITs of Mindspace Business Park. So this is an REIT. Huh? Okay. Third, directly buy commercial property in Mumbai and leasing it. Three different. Okay, which is traditional, which is alternative. You'll have to read all the options properly. Huh? So you can bifurcate actually. So, okay, first read the entire question, then I will move ahead. There's one more, buying shares of Hindustan Copper. So do you realize this is traditional? This is traditional, DLF. And REIT is also traditional, na? This is alternative when I'm buying a direct commercial property. So where do we see this happening? Shubham is saying D. REIT, DLF investment, Hindustan or traditional? Yes. Answer is D. It matches with our requirement. Correct? I hope everybody is able to connect. Reni? Varun? All good? Tarunesh? Josh. Okay. The next learning objective, guys. Okay. It is connected to the history of alternative investing in US. Now they have given you two histories, US and Asia also. Now this is generally where the questions might not come directly. Okay. Because they've just given a lot of information. So in the initial 1950s and 1980, what was the approach? Okay, so during this period of time, the concept of modern portfolio theory came into picture, which focused more on diversification. Okay, how institutional investments have evolved over time. So real estate and mortgages have been growing. Okay, people were investing more into that. They were buying government bonds. They were buying more preferred stock. So it's not a normal stock, preferred stock, where you get fixed returns, fixed dividend. And you're also the shareholder. That was there. Okay. Then slowly and steadily. So previously government debt was only where they were investing. Now they started investing into high quality corporate debt from 1920 to 1950 onwards. Right. Domestic stock market also growing. So people started investing into the stock market also. So this is a brief history that was also there in the book. So we covered it. From 1950s to 1960, modern portfolio theory came into picture. Modern portfolio theory focused that instead of buying only one asset, have a balanced portfolio so that your risk is managed. So you have to have assets which are low in correlation. That means they should not behave exactly same. They should behave separate differently. because if one asset goes down, the other asset is still there, which is protecting the overall portfolio, right? So investors should not look at investment in isolation, but as a well-defined portfolio. Okay, and the risk will only get mitigated if you have assets in the portfolio which are not correlated to each other. Okay, so when this theory came in, okay, from 1950 to 1980, most of the investment was, then people started investing into slightly riskier asset. So previously it was high quality corporate debt, now it started moving to medium quality corporate debt also. That means people started investing some portion of their money into high risky assets also. Previously it was more focused on safe assets like safe havens, like government bonds. Okay, international stocks market also boomed. So companies outside India, they can also invest into Indian markets. Okay, from 79 onwards, this concept, prudent person standard, you can mark this as star. What is this rule? Okay, if suppose I am a fund manager, I have other people's money. I should do the same with other people's money, which I'm going to do with my own money. If I'm not going to invest my own money into some new startup, then I should not invest my investors' money also. That concept, important. Okay, mark this as star. Prudent person standard. The rule is mentioned over here. Okay, and because of this, because there was now focus more on fund managers that started coming in, they started investing into high risky asset also. Why? Because they could diversify. So it's a combination of say government bond and stock. Okay, government bond is kind of safe. Similarly, you have high risky asset together. Both of them are making your portfolio stable. Okay, to reduce the overall risk. This concept of diversification will again come when we enter into the con side. Okay. Next is from 1980s to 2010, high yield corporate bond. This started increasing. High yield corporate bond is nothing but high risky corporate bonds, where the interest rate is high because the bond is very risky. A lot of people, they started investing into hedge fund and private equity market also, and the structured product market started going up, and which we saw the impact in 2007 and 9. Okay, we saw the impact in 2007 and 9. In fact, the University Endowment Fund. What is University Endowment Fund? Harvard Endowment Fund. Okay, a lot of people, they donate to Harvard, Cambridge. Okay, they have an endowment fund which they invest into the market to generate some return, which will help them to run the university. So that is also happening over here. They started investing into real estate heavily during that period of time. And 2010 onwards, private debt is growing. Direct lending, that is now becoming more at the core front. Then you have growth equity. A lot of startups, they started getting venture capital fund, PE fund. Okay, digital asset is now picking up, which is your Bitcoin and NFTs. All of these things are now going to pick up in the future. That is the broader trend. Why do institutional investors, you can mark this as star, this entire page is star. Why do they invest into alternative investment categories? Okay, so diversification is one very, very important rule, because what institutional investors, they've already invested into bonds, they've already invested into stock, right? And they now want to invest into those assets which are going to give them a stable return, basically going to manage or going to reduce the risk of already elsewhere invested. Simple logic. Suppose if I already have a lot of stocks in my portfolio, I will go and buy bonds because they don't behave similarly. They have a low or negative correlation between them. Okay, now when this happens, what is going to be the case? If the stock goes down, the bond will remain up and overall portfolio value will be managed. So first and very important point is diversification. That is also what mutual fund does. Mutual fund will invest into multiple companies. So one or two companies for it doesn't matter because the overall portfolio is managed. Second, it gives you higher return. Okay, institutional investors, see these few examples of institutional investors are pension funds. Okay, or for example, university endowment funds. Okay, or hedge funds. They want to generate high returns for their investors. Okay, they want to generate high returns to run their company. Okay, so entering into private equity, venture capital is preferable for them, because if the investment goes solid or if the investment turns out to be good, they'll end up making a huge money. Inflation protection, this is also an important, we talked about this, real estate gives you an opportunity to protect against inflation because the appreciation also happens. So from that perspective also it is going to be very, very helpful. Risk management, spread, this is same as diversification. Because what is happening, if I'm an institutional investor, I've already invested into stocks, bond. Now I want to invest into real estate, I want to invest into IP, I want to invest into private credit, I want to diversify. I want to make sure that my money is going to different types of asset class so that the overall return is going to be very good for me. Okay, I'm going to take a quick small pause, read till this point. Let me know if there is any confusion, any query. There's also a kind of summary which is highlighted over here. So past 100 years, what has been the case? In the initial year, what happened, mid years, then after 1980, this is kind of a summary. Okay, so you can just read this and summarize the entire learning objective. I hope everybody is good. This is more information driven. This and the next learning objective is slightly more information driven. Okay. We have few questions. Chalo, look at the first one. They're evaluating an investment opportunity in a private equity fund that focuses on early stage startup in India. The fund has some historical volatility and high returns due to lacks a long-term track record. Okay, the fund. Okay. While analyzing his investment, Vikram's team ensure that potential allocation aligns with the overall pension fund's risk management framework and diversification strategy. Given that the prudent person standard, which of the following action will most likely support Vikram's decision, which will match this framework? So basically, they have an opportunity to invest into a private equity fund. Okay, Vikram, who's working for HDFC pension fund. Now you have to tell whether he should invest or not. Okay. Rejecting the investment outright because it is a high risk and does not provide capital protection. We are not able to explicitly highlight that there is no capital protection. Approving the investment only if the past returns are consistent with the higher than the other asset classes. See, second is wrong. Why? Because if the past return is higher, it does not mean that in the future it is going to be higher. So this is straightforward wrong. Evaluating the investment based on its contribution to the overall risk return portfolio. That means we have to look at the risk of the overall portfolio. Don't just look at private equity funds standalone. You think of that private equity fund as a part of the overall portfolio where you have invested, and then see what is happening to the risk. Is the risk going up or is the risk going down? Because that correlation part will come into picture, na? Correct? So this could be a good answer. Investing into private equity only if other pension funds. This is straight away wrong. See, B and D straight away you can eliminate. Right? So answer could be A or C. Most likely it is going to be C because it matches with our concept of looking at the portfolio risk, not just looking at standalone risk. Okay, so whether you have to invest or not, you should think from the overall portfolio perspective. C, right? Answer is C. Look at the second question. This is slightly different. Look at the second question. Read the question properly. They are re-evaluating a fund strategic asset allocation policy. The fund has maintained 70% allocation to traditional asset, 30% to alternative investment. However, the rise of technology-driven businesses shifting this and this, Manoj is reconsidering the role of alternative investment. Which of the following is the most prudent approach for Manoj to optimize portfolio while managing risk effectively? Try to eliminate the option. See, this most likely is wrong because he's saying maintain the same ratio. Because historical performance says that it is going to be, things are changing, na? So you cannot have it. Reduce alternative investment below 30% since they are inherently more volatile. It does not, the question does not support that. It does not say that it's more volatile. Okay, so this is also wrong. Increase the allocation to alternative only if they outperform equities over the last. Again, see, this is highlighting if history is good, future should be good. That is wrong. As an investor, you should continuously reevaluate, look at what is happening in the market, and continuously take a decision to whether I have to adjust or not. Okay, you have to look at the trends, you have to look at what is the risk, what is the return that I'm getting, is it similar to historical, is it changing, and then so most likely the answer is D. Okay, most likely the answer is D. Okay, the next section is history of alternative investing. Okay guys, we're going to be starting now with the next learning objective where the focus is on history of alternative investing in Asia. Okay, we talked about the world, now we are explicitly focusing on Asia. Again, similar structure where they're going to be starting out with the initial years and then how the behavior towards alternative investment has changed. That is basically being discussed. Okay, so initially in Asian markets, the primary focus was gold, land and cash. You can mark this as star. Okay, the focus was initially on real asset. Okay, people were buying a lot of these precious metal, they were buying a lot of land, and they were also keeping a lot of cash with them. Okay, and this was prominent in India and China. Gold, historically, we have also seen our ancestors have been buying a lot of gold and land. Okay, and because initially stock markets were not in existence in these markets the way it was existed in the developed markets in the east, on the western side, right? Limited role of banking and debt. So initially the loans, okay, the investment people who had capital available, they were buying physical asset a lot and they were not putting it in banks. Okay, banks were in very initial stage, but debt market, okay, initially it was not good, not very big, but slowly and gradually debt market became big in both of these markets, especially if you look at Asian side, Japan. Okay, so previously they were only investing, they were only borrowing money from wealthy individuals or network to invest into business because bank as a concept was not there. Okay, and there were not any complicated derivatives, complicated assets available. It was only you were only able to get loan for a specific type of businesses only. Okay, this was the initial side. So there was limited role of banking and debt. Okay, so lenders only provided loan for specific purpose, avoiding any complex debt agreement. Okay, they wanted to keep it simple. Okay, now post World War II, growth started coming into these markets. Okay, especially the central bank, they got a lot of autonomy. Okay, the market learned from the western side and started opening up. The financial regulation also became eased out, and it became easy for you to raise money from the market. Especially the stock market started booming up in India post 1970s, 80s. The stock market started picking up. Okay, as an investor, you learned more about diversification. You can mark this as star. Okay, mutual fund, institutional investors started growing up, and the concept of diversification started coming to this market also. So a family-owned textile mill in India or South Korea in the 70s might have gone public by listing their share on a stock exchange to raise money to expand operations. So Reliance in India is one of the examples of early successes of stock market where they issued an IPO and raised money from the market. Private equity growth explicitly related to Japan in Japanese market. Okay, private equity started picking up across Japan and Asia, where there are a lot of lenders who started giving loans. They were not banks or financial institutions. They started giving loans. They started acquiring stakes in companies, right? And if you remember, if you know SoftBank, which is also a very big VC fund, and they have purchased stakes in Paytm and a lot of other startups in India. Okay, they invest into company and hold that company for a long period of time to generate huge amount of return. And the concept of incubator, now a lot of colleges have incubators in India, but the concept of incubators or accelerators are for those who want to boost their growth. Incubator is for those who have an idea, they want to test their idea. So these businesses, they got the help of these incubators and accelerators. This concept started growing up. So obviously previously it was in Western market, but in Asian market it started picking up. Okay, tech startup in Japan might have received funding from SoftBank to scale up operations. This is just an example. currently what is happening, okay, the hedge fund growth in the Asian market is very huge. Okay, in 2000 it was around 10 billion. Now it has gone up to $300 billion worth of investments are happening. Okay, different hedge funds have come up with who are following different strategies, and where they're getting money, okay, even from small time HNIs. Okay, the requirement to invest is very small. There's a concept in Indian market called PMS, which is portfolio management services. 50 lakhs, even if you have 50 lakhs of money, you can invest into that and your money will be managed by a professional person. Leverage limits is there. Okay, so different countries have different rules with respect to how much risk you can take, how much leverage you can take. Okay, in certain countries, short selling is not allowed. In Indian markets, stock markets, mutual fund industry, right now, stock selling is not allowed. Okay. Credit market. So, like I said, private credit was previously only, the credit was only available through banks or through your financial institution, but now that has gone up. So in the Asian markets, private credit product is easily available. Okay, people are willing to invest, willing to give debt to private companies through a lot of platforms. A lot of fintech platform has also come. So the overall debt market is now booming. If you look at US debt market and Indian debt market, the US debt market is way too bigger. Now here also the debt market is picking up. You have venture debt, you have private debt available to different types of companies or investors who want to grow in the market. Okay, again, slightly information driven content is here in this learning objective. Importance of real estate and infrastructure investment, one of the kinds of real asset that we talked about. Okay, so historically real estate dominance was there in Asia. That means as an investor in your portfolio, real estate will be there as a part. But that was more on mortgage side, or that was more on residential side. But now it is moving away from residential. It is moving to commercial, where investors are putting money with the government, public-private partnership, and they're building infrastructure projects. There are institutional investors who are creating special purpose vehicles, special investment vehicles, companies on paper to invest into these projects. Okay, very good example of this is REIT. We have already talked about REIT, right? So REITs in Singapore or India are now picking up. In India also REITs are there, and it is going to grow in the future, where you as an investor can directly participate into real estate or infrastructure project. Okay. So we are now entering into the next learning objective. The last two learning objectives were slightly theoretical. Over here in this part, we are going to focus more on how return is generated for alternative investment asset and how it is different as compared to a traditional investment asset. So now some concepts are going to be there, okay, which they're going to be touching, which we're going to be touching base over here. First, diversification. Okay, so generally we say that don't put all your eggs in the same basket, right? That is nothing but diversification concept. So try to invest into different types of products, different types of asset class, and if you're able to invest into those assets which has low or no correlation, that is best, because almost all of them are then independent. Because if you have assets who are highly correlated, then if one asset goes up, all of them will go up, but if one asset goes down, all of them will go down. This is a big problem. So the first concept that you're going to be reading over here is diversification. Okay, there's one more concept which is nothing but absolute return. Now you can calculate return either in absolute format or in relative format. What is absolute? Suppose if I have an asset A, and this asset, okay, has been able to give me 10% return. So I will look at this 10% on an individual basis, that is absolute return. But suppose I want to compare this with an index. Okay, index has been able to perform at 7%. So on a relative basis, when I'm comparing it to somebody, I am only able to generate 3% better. Okay, so generally when you look at any asset, first you look at what is the absolute return. Okay, and you do not compare it with anything. In mutual fund industry, you look at relative performance. Whatever your fund is growing, you're going to compare it with a benchmark or an index trying to understand whether you have performed better than the index or whether you have performed worse than the index. Okay. So over here, okay, when you look at the overall concept, not all alternative investment provide absolute return. Like for example, private equity. See, private equity is where I've purchased shares of private companies. Now these private company shares are not easily valued. So it is very difficult for you to understand what is the current return that you have generated. You will only get this information when you are selling it to somebody else. Correct? So it is not readily available. The way the stock prices are readily available on an exchange, for a private limited company, the stock price is not readily available. So you're not able to calculate what is the absolute return immediately. You'll have to hire somebody to do that valuation. Okay. Hedge fund uses long short strategies. So basically they're creating a portfolio where they're buying certain assets and then when they're selling certain assets. So long short means you're trying to buy also, you're trying to sell also. Okay, so suppose if you feel that the market is going to go down, you will buy lesser, you will sell more. If you feel that the market is going to go up, you'll buy more and sell lesser. Okay. I'm going to take a quick pause till this point, just the first section. Let me know if there is any confusion over here. I hope everybody is doing good till this point, right? So first point is diversification. Second point was absolute return. Now we're going to be looking at illiquidity. Now what is illiquidity? Okay. So, see, you have to think it like this. If I am having an asset and if I'm going to sell that asset, if I'm able to sell that asset immediately in the market, there is somebody, some buyer available, then the liquidity is very good. So if you go and buy government bond and you want to sell it, so buying and selling is happening fast because there is liquidity in the market. If the asset is illiquid, the way you have real estate, it takes time for you to buy and sell, right? So in that case, the illiquidity creates additional risk. Okay, so what is liquidity? How easily you can buy or sell particular asset. Okay, now most of the alternative investments are illiquid. For example, if you look at real asset, you look at hedge funds, you look at private equity fund, it is very difficult for you to sell your stake to somebody else and exit. So illiquidity is a very big problem. And because there is illiquidity, there is high transaction cost. Now, what is this high transaction cost? I'll give you a very simple example. Suppose I wish to buy a property in Mumbai, okay, certain areas, okay, of Mumbai. I might not have the knowledge of that area. So I will have to engage a broker. He will take some charge. Second, to finalize the deal, I might have to get a lawyer on board. That is also going to add cost for me, right? So if the market is illiquid, okay, generally the barrier for you is higher. You might not be able to identify the price properly, the rules and regulation properly, and hence there is higher cost for you to enter into the market. Okay, so illiquidity, please remember this. Also look at this section, lumpy asset. See, when we are saying lumpy asset, it basically means you cannot break it into small parts and sell it. You have to sell the entire part. Okay, for example, if I have a 5 BHK house, okay, I cannot bifurcate into 1 BHK, 1 BHK, 1 BHK. I'll have to sell it entirely 5 BHK. Right? It is very difficult for me to bifurcate and sell. These are called lumpy asset. Mark this as star. Okay, stocks, you can sell 10 shares of stock Tata Motors, which is listed on the exchange easily. But suppose if you have purchased private company, okay, and you want to exit, you have 10% share. It might be difficult for you to sell 1 or 2% share. You might have to even exit. You might have to exit entire 10%, or nothing will happen. Okay, so these assets are called lumpy because other side or the buyers might be interested to buy the entire 10%. They might not be interested to buy 1 or 2%. Okay, so these kind of asset becomes lumpy. When it is lumpy, it is difficult to sell. Okay, real estate is a very good example of being lumpy. You cannot bifurcate and sell. Okay, very difficult to do that. Why does illiquidity matters? Mark this as star. Now, if there is high illiquidity, it is going to take time for you to sell. Till that time, your money is stuck. Okay. You have the risk also that the price can go down. Correct. So investors who can wait longer to sell can wait for the better price. Okay. And it creates more illiquidity because everybody is waiting in the market and nobody is willing to sell. Okay. Next is, if you want to sell quickly, you will have to sell at a discount. This is called haircut. I have purchased a property at 5 crore rupees. Okay. Now, because I need urgent money, I'm going to sell it to somebody at 4.5 crore rupees. That is nothing but haircut. Okay. To compensate for this, investors in illiquid market demand higher returns because there is high risk, because there is high transaction cost. If I am going to invest, I would need high returns. That's why real estate as a product gives you high return because there is huge transaction cost. It takes time for you to find the buyer or seller. There's a lot of regulatory requirement. Okay, a lot of capital involved. So hence it gives you good amount of return over a period of time. Okay, I'm taking one more small pause, asking you guys to read. I hope everybody is doing good. Next is market inefficiencies. Now this concept, when the prices are not perfect or prices does not reflect the true nature, okay, then it tells you that the market is inefficient. Okay, look at this section. An inefficient market is the one where an efficient market is one where all the information is reflected in the asset price. So if you go to Western markets, okay, where generally the information is quickly captured in the price. So you do not get a benefit of having that information. But if suppose you're in a market which is developing, okay, it might take time for the price to reflect that information. Then the market is inefficient. Okay, an efficient market will always have high level of competition because there are so many people who are chasing information and immediately trying to use it. Okay, immediately trying to use it. But when you look at alternative investment, the market is inefficient because the information is not easily available. Very simple example, real estate. Okay, if you want to understand the price of a property, there is no portal, nothing available where the price will be easily highlighted. It is based on the negotiation. Correct? So alternative investment as a category is generally inefficient. Why? Mark them as star. Very few buyers and sellers are there in the market for one property. Okay, and because very few buyers and sellers, the price discovery takes time. Okay, till the time we meet, we discuss, we negotiate, and each property is different. Huh? So we cannot have a standard price for everybody. Okay, so the first problem is because there are very few buyers and sellers, illiquidity is there in the market and it takes time for you to sell, and hence the prices are not easily available. Second, high transaction cost. I have already talked about this. Because there is high transaction cost, not everybody is able to come into the market. Right? Because even if you have money available, you might not be interested to buy a property because you feel that you don't know anything about that market. Correct? So that is leading to, because you will have to get a broker in between and you might not trust the broker. Okay? Limited short selling option, making it hard to correct mispricing. So if the prices are very high, how will the prices come down? If everybody starts selling, the prices will come down. Okay, but to sell, if there is no direct option for me to do a short selling. I have to first buy a property and then sell it, correct? So in this case, because there is no short selling available, even if the prices are higher, it is not coming down. It is not coming down. Okay, mark these 3 pointers as star. Okay. Publicly traded stocks is an efficient market. Why? Because information is easily available. If you look at private real estate, it's an inefficient market because you don't come to know whether the price is actually overvalued or undervalued. Till the time you are an experienced person in that market. Okay, so overpriced or underpriced is very difficult to identify because the information is not available. Okay, and because the information is not available, if there is any mispricing, that means if there is a property which is undervalued, you can go and buy. If it is overvalued, you can go and sell. But that is not possible because the information is not available, and hence, if there is any mispricing, you cannot explore that. You cannot exploit and earn returns. You can mark this star. The last 2 points. Okay, you need to have that skill. You'll have to spend time in the market. Okay, you have to understand how the market is working. You need to have network. Then only you will understand all of these things in detail. Right? I'm going to take one more small pause over here. Read and let me know if there is any confusion till this point. I hope everybody is reading, everybody is good. Let us go to the next part, non-normal returns pattern. Okay, now this is connected to the concept of normality. So I hope everybody has seen bell curve. Have you guys seen bell curve? Bell curve, normal distribution. Yes, no, yes, no. Vibha, Prachi, Guru, all good, right? What is bell curve? So it is symmetrical. 50% on this side, 50% on this side. Okay. The point over here, the point, it is also the mean, mode, and median. When we say non-normal, one example of normal is this, left skewed. So when I cut it from between, it is not 50-50%. And also the tail, because the average is here, and you're far away from the average, there are a lot of data points. So for example, if the asset is going to give me an average return of 3%, if it is negatively skewed, there is some possibility of negative 30%, negative 45% return also, which is a problem for me. Okay, so this is negatively skewed. You can also have right skewed, which is this, with a fat tail on the right hand side. So we are comparing it with normal distribution. Okay, tail means far away from the average behavior. There are certain situations, certain data points which are there. So what happens is when you invest into alternative investment category, most of them, they follow a non-normal behavior. Okay, see, this is an example of normal. This is left skewed and this is right skewed. Left and right skewed. Okay. Now, why does this happen? Because see, normal distribution means bell curve shape. That means most of the data is closer to the average. Behavior is closer to the average. Okay. But alternative investment, they deviate from normality. They're slightly skewed. Why? First and very, very important reason, infrequent trading. That means you're not buying and selling in the same way as the stock shares listed on an exchange. Prices are not easily available. Transactions are happening, say for example, if it's a skyscraper, big tower, okay, once in 5 years, 10 years, the transaction will happen. Okay, so it's not happening that frequently. Next, derivatives and leverage, because you're using futures and options, it creates the strategy entire complex. Look at hedge fund. How will you understand whether the return is normal or not? The return is going to be skewed. The reason being because you're using extremely complicated strategy to generate return. Okay, so stocks and bonds are generally normally distributed, but when we look at hedge funds and derivatives, it is slightly asymmetrical in return. So it could be like this, that there is big gain and big loss. Okay, it is not balanced. Okay, your risk is slightly higher. Now, how does it impact? This paragraph is also important. If the returns are not normal, okay, then there is a good chance that you might be underestimating the risk. And because you are underestimating the risk, okay, when you compare risk and return, you might find that the return is very good, but you might not be able to understand the risk is also very high. There is underestimating happening and you are not able to see the true risk. Okay. So portfolio manager must adjust their risk calculation when they are looking at alternative investment asset. That means as a risk manager, you need to be clear that because I'm investing into alternative investment asset, okay, the risk is going to be slightly higher. That is the reason I'm getting high returns. Okay, that is the reason I'm getting a high returns. Okay, so non-normal return, we have covered that. There is a quick summary. We have talked about these 4 pointers. Mark this summary as star. It will help you to cover the concept properly. Right? I'm taking a pause over here. Any confusion, any query till this point? Any confusion, any query till this point? All good? Methods of analyzing alternative and traditional investment assets. Some parts are important. I'm going to highlight a star. Okay. 4 key methods, return computation methods. Okay. How the returns are calculated. See, return, most of the thing will boil down to either return or risk. Okay, statistical method. So we're going to be looking at standard deviation, variances, correlation, covariances. All of this is going to focus more on the risk side. Okay, return is nothing but the average return of the portfolio. That is what we are going to be calculating. Now to calculate the returns, you need to do the valuation of the asset properly. Okay, see, for example, if you have invested into an asset at 100 and after 1 year it becomes 110. So you can say, oh, I have generated 10% return, correct? But to calculate this return, you need to know what is the valuation at this point and this point, what is the price of that asset, correct? So valuation methodology is also important, right? Second and very important point over here is portfolio management. Suppose if I have a portfolio P and I have asset A and asset B. Now, what is the risk of my overall portfolio? I know the risk of individual asset, but when I combine them together as a portfolio, okay, because of the correlation between them, how the risk is going to change. That is basically covered in your portfolio management methods. Okay. So look at the first one. Why traditional methods are not enough? Okay. Stocks and bonds, they trade daily. The information is easily available. Okay. But when you look at alternative investments, information is not easily available because they're not purchased every single day. And because of which what happens? You do not have the price. When you do not have the price, it becomes very difficult for you to calculate the returns, right? It is very difficult for you to calculate the returns. Suppose you are investing into a project, okay? You can calculate the IRR, which is nothing but internal rate of return, based on what is going to be the future cash flows of that project, right? So you can look at the cash flows of the project, that is also possible, but that there is subjectivity into that. If you expect that I'm going to get 5 lakh rupees from that project after 3 years, that might change because of XYZ reasons. Okay, because of government rule, because of market conditions, right? So look at this example. If you have invested 10 lakh rupees in a private equity fund, okay, and after 5 years you receive 20 lakhs. Okay, so you know what is the starting price, you know what is the ending price, and then you can calculate the IRR. But if you're not able to calculate the price, return calculation is very, very difficult. Okay, one connecting point over here is leverage. Now suppose you have invested, you have invested 100 rupees into an asset. After 1 year it becomes 110. But out of this 100 rupees, you had only put 20, and 80 is the borrowed money. 80 is borrowed money. So you have to pay the interest also, that will reduce your return, correct? that will reduce your interest. So as an investor, you have to be clear, okay, when I'm calculating return, how much component is coming from the leverage part, because I borrowed money, okay, how much my return is going to get changed. So I have to adjust my return. Next is notional principle. Now, when you read about futures and forwards or derivative in this curriculum, you will understand that notional principle is not exchanged. It is only used for calculation. So when you look at swaps, when you look at your options also, a lot of option contracts, you have the notional principle as a concept, which is not investment. It is just used to calculate. So if you look at notional principle, you will get a wrong picture. Okay, so it is only used to calculate return. I'm going to take a short pause, read till this point. Next is statistical method. Now over here, our focus is to understand the risk. Okay. Now look at this normal distribution. This is an example of normal distribution. So this is my average. Okay. And data is spread out equally. As you move away from the average, the distribution is going down. Okay. This is a normal distribution, which is also called as a bell-shaped distribution or bell curve. But a lot of asset in your alternative investment, they have an irregular return pattern, which basically means that they are having a skewed returns. 1 second. This one. This is what? This is right skewed. Okay. This is an example of a left skewed. This is negative side. This is positive side. So when you have right skewed or left skewed, the problem is that the far away from the average, there are certain data points. Now this could create problem for us, right? So as an investor, you need to understand whether the asset follows a normal distribution or whether it follows an irregular distribution. Because when you're going to calculate the risk, and the very famous tool to calculate risk is VAR, value at risk, which we're going to be doing in detail. Okay, it tells me if there is a bad time, what is going to be the loss? What is the worst case loss that can happen? Okay, so you will calculate this VAR also, which is a form of risk. You will also look at skewness and kurtosis. Now this skewness, this is right skewed and this is left skewed. Okay, there is a concept. Skewness basically tells you how far you are away from the average. Okay, and you're not symmetrical. Your distribution is not symmetrical. But if we are going to move, look at kurtosis. So look at this. This is my normal distribution. Okay, and this is an example of a leptokurtic distribution. When we talk about leptokurtic distribution, it has lot of data close to the average, but it also has fat tails. When you're saying fat tails, that means there is a lot of data away from the average also. This creates higher risk because if suppose my average return is 5%, it can go down to negative also, it can go down to positive also. That is creating problem for me. That concept is called as skewness. So whenever you have asymmetric data, skewness and kurtosis becomes a bigger issue. Okay, skewness and kurtosis can become a bigger issue. Again, all of this will come in your statistical section in detail. Next point, why is valuing a alternative investment is slightly difficult? Okay, because if you look at, if you go to stock market, there are two prominent methods of doing an analysis. One is fundamental analysis. What is that? You open up the balance sheet of the companies, income statement of the companies, and you basically try to understand how the company is performing. Okay, you basically do the fundamental, look at the business of the company. You can also do technical analysis. You look at charts. You will go to YouTube. You'll find so many companies, so many people who are doing chart analysis. Okay, that is also a method to analyze whether the stock is going to perform or not. So fundamental analysis, look at the details of the company, look at the numbers of the company, balance sheet, financial statements and all. Technical, they will look at the charts. Okay, the stock charts, and based on that they will come to the analysis that whether the price will go up or down. This is generally used in the stock market, okay, but this is problematic. You cannot use the same methodology in alternative investment. Why? First, these assets are not traded, there is no trading happening daily, but if there is no trading happening daily, then technical analysis cannot happen. Logical, right? Next is they only trade in private market, they are not listed on an exchange, so there is no clear information. For example, what is the balance sheet of venture capital fund? It is not available in public domain to everybody. The way you have availability of the financial statement of Tesla or say Apple, right? Price discovery is also very difficult. Why? It's connecting point, because buyer and seller is not there, so daily transactions are not happening and daily prices are not available. So in alternative investment, you have different method of doing valuation. Okay, appraisal based valuation. This is generally used in real estate. Now suppose if I want to take a loan, okay, personal loan, and I've given my property as a guarantee. So bank will basically send out their appraisal team. They will come to the property, they will do the measurement and they will look at the property, they will take photos, and based on that they will give you a report. This is the current value of that house in today's market. Okay, so you have a skill based valuers or appraisers who will do the entire valuation of that asset, generally used in the real estate market. Okay, there can also be transaction based pricing, where you compare it that with something similar happened in the past. Say last year similar property was sold, and then you adjust the price. Okay, that means you say that similar property was sold for 1 crore and I have some extra benefit, so it is going to be 1.5 crore. Likewise, so it can be transaction based also, based on what is happening in the market. Active trading models, okay, this is rarely used in the market, where they say, when they look at what is happening with the security, what is happening with the asset, okay, and they try to benefit from short-term mispricing. Suppose there is a news that there's going to be airport which is going to come. Based on that, in the short run, the real estate prices will jump. So you take benefit out of that. So it is more news driven. If there is any short-term mispricing, I will try to exploit that short-term mispricing in the market. Okay, that is the idea. So look at the examples which have been given over here. We've talked about appraisal value also. Kindly read this entire section. I hope everybody is good. Portfolio management services. Now over here, portfolio management services, we talked about this because effectively, okay, you do not have to look at the asset on a single basis. You have to look at overall portfolio and whether this alternative investment is a good fit for me or not. Okay, so you have to look at portfolio management at an entire level. Okay, now how this is happening at an alternative investment part rather than traditional. See, in traditional markets are liquid because buying and selling is happening. Stock market, every prices are easily available. There are so many buyers available, so many sellers available. Okay, low transaction cost. The cost of doing transaction on a NSE or BSE is very low as compared to if you go to an open market and do the transaction. Okay, risk can be calculated properly because the data is available. Calculation of risk becomes easy. But in an alternative investment space, you do not follow these assumptions. Why? Okay, we do not follow these assumptions. The overall idea over here is we try to track, okay, we try to look at the liquidity of the portfolio. Okay, because if there is an alternative investment asset available, I try to take a decision that if suppose I purchase this, how quickly I'll be able to sell it. But in alternative investment, it is very difficult, right? It is hard to sell them quickly. So you as an investor are aware that there is a liquidity issue. A lot of these assets are illiquid. Okay. Next, you're also aware about skewness and kurtosis. That means the data is not normal in behavior. Data is not normal in behavior. Okay. Emphasis is on absolute return, not just comparing with the benchmark. Now this comparison part is highlighted. Why? Because in most cases it becomes very difficult for you to find a benchmark to compare. It becomes very difficult for you to find a benchmark to compare, right? So that has been highlighted. So this section, a hedge fund manager adjusts the portfolio to include a liquid investment alongside with illiquid. So it's a, when you're looking at the portfolio, some assets in your portfolio is going to be liquid, some asset in your portfolio is going to be illiquid. Okay. This is a summary of whatever points we discussed: return, statistical, valuation, and portfolio. Quick summary where there is a comparison between traditional and alternative investment. I hope everybody is good till this point. Can I get a quick confirmation on chat?